After years of fairly steady growth, pretty much in the double digits, lending to Kenyan households contracted in December and January as measured on an annual basis. Outstanding debt to households was anywhere between 3.8 billion and 3.9 billion in both months, but it fell by 1.5% in each month compared to the same period a year earlier. Lending to trade, manufacturing, real estate, that went up over the same period by 7%, 12.2%, 8.4%, but nominal credit growth by itself was still relatively low at 1.8%. So if you factor in inflation, really, credit growth is actually negative. Osoro is in charge of the research unit at the Kenyan Bankers Association. After a loss of 1.2 million loan accounts and 1,400 jobs, I asked him if the only beneficiaries of this rate capping law are larger firms and the Kenyan government.
One way of looking at this is that if you cap the risk that lenders are going to take, then they're basically going to look at how they can adjust with a view to continue lending while they're basically not subsidizing the market, as it were.
Right. One of the other things I've noticed looking at just the headline numbers, especially for the first quarter, we're starting to see a reduction in the amount of debt that's actually held by households. Is that because they're not able to access debt, so they're paying down whatever they are, and there's no new debt that's being originated from the bank side?
Two things are in play there. One of them is that those who actually add debt at substantially higher prices, meaning therefore that for them the constraint was access, perhaps retired those debts and therefore they're not able to access a new debt. And second, you have to look at it in the context of the overall reduction in the rate at which the debt has been growing. If you look at it on an annual basis, the numbers have been growing, has been coming down. But month on month, the instances where actually the rate of growth has been negative, meaning actually the debt has been shrinking, and more so to the households and small businesses.
So how do we split this out between the effect of the rate cap, reducing accessibility to debt, but also disentangle the effect that IFRS 9 may have had? Because now at this point, starting in January, banks have had to essentially set aside capital for any debt that they do put out, which by itself should at least limit the amount of capital that's available to be lent out.
I think it's not a case of a disentangling. It's basically a case of looking at the combination of the two. So the contributory effect of both the capping and the IFRS 9 point to the scenario that you've just described. I think there's one thing that perhaps I need to address while you're looking at those factors. Historically, and this is something that we've emphasized from our analysis, whenever there is a new policy that amounts to a new adjustment, or whenever there's a market shock, you see the market responding in a certain manner, and the credit, at least the rate at which credit expands, reverts to what you can call the natural average within a period of 2 to 3 months. From the end of the year, we've seen that adjustment not happening. And that is the period where now the IFRS 9 is coming into play, and the adjustment in line with the interest rate coming also now settling in terms of the market settling into the interest rate capping. So that a combination of those two basically builds into the picture that you've precisely painted. So it's not a case of disentangling, but a case of looking at how a combination of those two.
So both of those are basically suppressing lending. But moving forward, though, because we're coming up to a period where the budget is coming in, the finance bill has been described as the instrument through which the government might try and reform the Banking Amendment Act of 2016. Assuming, for argument's sake, that we do reach some sort of accommodation, right, for lack of a better word, how can banks then move into differential pricing? Because one of the arguments that has been made is under the old regime, it didn't matter what your credit score was, you'd essentially all get priced at 19 to 21%. How then do we move the sector into differential pricing by default, as opposed to it being something that banks can choose to adopt?
I think it's a case of really entrenching fully the CIS mechanism, the credit information sharing mechanism. As it is right now, many of the lenders use the credit information that is shared for purposes of making a credit decision. That's not what that information is supposed to be for. That information is supposed to give you an indication of the risk profile of the borrower. So the analytics of the CIS mechanism has to be entrenched in such a way that now it makes it more compelling for one to look at somebody's credit profile and therefore differentiate in terms of pricing depending on profile. That way you'll basically end up avoiding good credit, subsidizing bad credit, and that builds into what you're saying, people having their rates being in the range of between 17 and 21%.